used for production. Well, they would be in their own inventory account. And then as you are working on those goods, you're going to need to use some of those materials in production. You're going to need to pay your laborers who directly manufacture your product their salaries in order to convert those raw materials into something that is sellable. And you're going to incur those overhead costs, your three cost components. Well, your three cost components go into an account called work in process, or as I call it, WIP inventory. And that is the cost that you have that are in products which you haven't finished yet. And then once you're done producing that product, it's no longer a work in process, it's a finished good. The costs get transferred out of WIP inventory and into finished goods inventory. And they sit in finished goods inventory sitting around, meaning you have inventory in your wares that is in a finished sellable condition. You could sell it at any minute. And when you actually do sell it, well, then you take it out of finished goods inventory and you put it in cost of goods sold. So all types of inventory that you have follow the same exact flow. They start as raw materials inventory. They get transferred from raw materials inventory into work in process, where also the cost of direct labor and manufacturing overhead are accumulated. Once you are done producing it, it comes out of WIP and goes into finished goods. And then once you actually sell it, it comes out of finished goods and goes into COGS. So to figure out what our cost of goods sold is for a manufacturing firm, we're going to have to figure out what were the costs that we incurred during production for the period, which they refer to as your cost of goods manufactured. Well, to do so, what you need to figure out is what were the direct materials that are used for the year. And you do that by tracking the changes in your raw materials inventory account. What other manufacturing costs did we incur during the year? What was our labor and our manufacturing overhead? That's all the stuff that goes, into WIP in addition of those direct materials. And then ultimately, what is our cost of goods manufactured? That was the changes that you had to WIP. So here, I'm going to start by asking this really goofy but pertinent question. If a man had 4 cans of Pepsi in his fridge and he purchased another 6-pack, and then he went in the fridge later that night and went to look to see how many Pepsis he had left, and there was only one, and he knew that his son had started chugging down Pepsis, how would he determine how many Pepsis his son drank? Well, he knew that he started with 4, right? And he purchased another 6. So at that point, there was 10 Pepsis available to be drank in his fridge. And if he went and looked in the fridge later to get himself a Pepsi, and there was only 1 left in there, well, by process, if there was 10 and there's only 1 left, his son must have drank 9. And that is the same exact process that we just use repeatedly for a manufacturing firm over and over and over again to figure out the changes in our different inventory accounts. You always take your beginning, add to it your additions, in this case the amount that was purchased, and that gives you the amount that was available for use. And then you subtract out whatever you have left, what you didn't use, and that gives you how much you actually used. And I will refer to this henceforth as the Pepsi formula because it just needs a name, and that's the best thing I've found so far for my students from this particular slide. So for our cost of goods manufactured, our first step is to figure out what amount of direct materials we use. But we can use that Pepsi formula to get there. If we start with the beginning amount of direct materials, again, just raw, unfinished stuff that's sitting around that we had at the beginning of the period, and we add to it the amount that we got during the period, our additions, well, that gives us how much we could have used. So if this particular company had $70,000 in direct materials when the period began, and they bought another $350,000. That means they have $420,000 of direct materials, which they could have used during the period. But they probably didn't use all those direct materials in production. No company ever runs out of raw materials sitting around. Which means if we just take whatever they have left for direct materials at the end of the period and subtract it from what they could have used, they give you the amount that's actually used. So this company, let's assume they went through and they looked at the books and they did a physical count of their remaining direct materials inventory, and they had 65,000. Well, if they could have used 420,000, but they have 65,000 left, that means by process of subtraction here, that their direct materials that they used during the period was 355 grand. And that's one of the 3 cost components. So the second step in calculating your cost of goods manufactured is to add the other 2 cost components, which is your direct labor and your manufacturing overhead. In direct labor, people punch in, they have time cards etc. So you know how much labor costs that you incurred. Your payroll office will definitely know for the period. So in this case, let's assume that Smart Touch Learning, our fictitious company, had $169,000 in direct labor. Well, we can add that to the $355,000 worth of direct material costs that we just had right there to start coming up to our total amount of costs that we incurred during the period. That would be our total direct costs. But there are indirect costs, manufacturing overhead, which were necessary for production, but we don't have a good way to trace. Things like indirect materials, indirect labor, depreciation on things as long as they are directly tied to production, so our production plant and our manufacturing equipment, and all of the costs that we have to pay on those facilities, like our utilities, insurance, and property tax. We would take all of those, add it up, and get to our total manufacturing overhead. And then to figure out what amount of manufacturing cost you incurred during the period, in this case the year, you just add together your three cost components. So Smart Touch had $355,000 for the direct materials they used. They had $169,000 for the direct labor that they paid for, and they had $83,000 worth of manufacturing overhead costs. That means that in total they spent $607,000 on production during this period. Well, we were working on inventory, and I'm assuming when the period started, we probably would have had some inventory which costs had already gone into, like we were working on it when the last period ended, but we hadn't finished it yet. Well, those costs are still going to have to, count towards our overall value of inventory. So if we use the Pepsi formula once again to figure out what our cost of goods manufactured were, we're going to do the same steps that we did for direct materials. But this time, we're not going to do it for direct materials inventory. We're going to do it for WIP inventory. So if you take your beginning WIP inventory, all of those costs in products which were started but not yet completed when the period began, you add to it all of the costs that you incurred during the period, you come up with your total manufacturing cost to account for. So if we sold each and every little bit of product that we had, if we finished production of each and every product that we had during the period, that would be the amount that we spent on making finished goods. But the problem is we probably are going to end this period not having completed all our different jobs or products. We're going to have costs that are tied up in jobs that aren't done yet and therefore aren't manufactured yet. They're in the process of being manufactured. So if we take our total manufacturing cost to account for, subtract out the portion of that we have tied up into jobs which are still in process, our ending WIP inventory, we get the cost that we paid during the period for jobs which we have actually finished. So here we had $687,000 of cost to account for, but $27,000 of that was tied up in jobs or products that were in production when the period ended, which means $660,000 of that $687,000 must have been put into jobs which we actually finished producing during the period. And to calculate this out, you usually use a document, which is purely internal for managerial purposes. No one outside your company is ever going to see this, called the Schedule of Cost of Goods Manufactured. And how you start it is you start with your beginning WIP, and then you figure out what your manufacturing costs incurred during the year are. Well, we got that information here because it's our three cost components. It's our direct materials, it's our direct labor, and it's our manufacturing overhead. So we use that Pepsi formula. Again, beginning plus additions gives you the amount available, less what you have in ending gives you the amount that you actually used, to determine that we had $355,000 worth of direct materials. We know to a T what our direct labor costs were, and we also know what our manufacturing overhead costs were. So you add those up and you come up with your total costs incurred during the period. Add that to your costs that were already put into inventory, which was in process when the period began, to get your costs that you have to account for. And then subtract out the portion of those costs to account for which are still tied up in inventory which you haven't finished yet, and that will give you the actual amount of cost of goods that you manufactured during the period. And you go through this whole process of making this schedule here because you need that bottom number for your income statement when you figure out what portion of the inventory that's gone through your company you actually get to expense as a cost of goods sold. And that is the Pepsi formula one more time. We already did it once for raw materials or direct materials inventory. We already did it for WIP. Now we got to do it for our third inventory classification, which is finished goods. So to figure out what your cost of goods sold are, you take your beginning finished goods inventory. Let's say the Smart Touch here had 0. You add to it your cost of goods manufactured, which I'll back up for a slide here, was found at the end of the Schedule of Cost of Goods Manufactured. And that gives you the total amount of stuff you could have sold. So SmartTouch had 0 inventory, must be a new company. And you add to it the cost that you incurred to manufacture goods that were finished during the period and therefore could have been sold. You get your cost of goods sold available for sale of $660,000. And they probably didn't sell every last product they had. They have inventory sitting around which is done but has not yet been sold yet. That's your ending finished goods inventory. So if you take that cost of goods available for sale, subtract out your ending finished goods inventory, that gives you how much you actually sold. And their cost of goods sold for SmartTouch in this case would be $600,000. And then when they report that on an income statement, for the cost of goods sold section, instead of just writing one line item, you show it by having your changes to your finished goods inventory account. So you display, in the case the left-hand column, the Pepsi formula one more time. What you started with, what you added to it, gives you what was available, and then you subtract out from what was available what you didn't actually sell to figure out what you actually sold, which you report as your cost of goods sold. And your sales revenue, less your cost of goods sold, gives you your gross profit. So how much money you made in markup, essentially the difference between what you paid to manufacture it and what you sold it for. So in SmartTouch's case right here, they had a gross profit of $400,000. But in cost of goods sold, that's not all the costs they incurred. It's only the inventoriable cost, the product cost, the things that are directly related to manufacturing. They had other things they had to pay for too, like the wages of their selling staff and their administrators, like the rent on their administrative office and the insurance on that building and the depreciation of the equipment within that building and the cost of supplies used by those people that are not directly related to manufacturing. Well, all of that is a period cost, and they call that a selling and administrative expense. So you have your gross profit. That is just taking into consideration the actual cost of manufacturing that you had. If you take all of the other period costs that you had, your S&A expenses, your selling administrative expenses, and subtract that from gross profit, you get operating income, which is the amount of income they made purely from operations. But there are other components to a business that they have to pay that aren't related to actual operations. You pay them for purposes besides, the things that actually happen within your business, like interest on your loans that you would have, or taxes that you have to pay to the government. And if you subtract all of those non-operating costs, as they call them, from your operating income, that gives you your net income, your bottom line, what you took home at the end of the period for production during the month.
Hello everyone, this is your Intro to Managerial Accounting quiz, or your Chapter 18 quiz on Pearson. For this quiz, you're going to have to do two things. You're going to have to make a cost of goods manufactured schedule. This is a document which keeps track of the total costs of goods that you produced during the period in which you finished manufacturing. And that last part is the important part. We're not looking for the total amount of money we put into all of the stuff, because we would still be working on goods. We're only looking for the total cost of everything that finished production during the period. To do this, you're going to need a couple of things. You are going to need both the beginning and ending balances of your three inventory categories, which are your direct materials, your WIP, and your finished goods. And then you're going to need some other pertinent info, like how much direct materials you purchased during the period, what your indirect labor costs were, what your administrator salaries were, etc. This is all compiled for you on the left-hand side, so you can follow along. On the cost of goods manufactured schedule, the first thing you always start with is your beginning WIP. So if we go and we see on the left side, second line down, our beginning WIP inventory was 0. We're going to throw that into the right-hand most column. To that, we need to proceed by figuring out our direct materials used. This also starts with beginning inventory, but this time it's beginning direct materials inventory. So we take our beginning direct materials inventory from our information, which is 13,000, and we add to it any purchases of direct mats that we made during the period. First line under other info tells us that we purchased $30,000 worth of direct materials. We started with 13,000 and we bought another 30,000. That means throughout the month, in this case, we had $43,000 worth of direct materials available. Well, we're not trying to figure out what was available, we're trying to figure out what we actually used.